Investors are keeping a close eye on next month's Federal Reserve meeting, seeing if the central bank will, in fact, cut rates for a third straight time by at least a quarter of a point. Stocks moving higher yesterday on the expectation that we will see another cut. Fed Chief Jay Powell under pressure from the president to keep cutting interest rates as we see promising inflation numbers and economic data. Joining me now is Federal Reserve Governor Stephen Miran. Governor, great to have you this morning.
Morning. Thanks for having me.
Congrats to you. You have been advocating for Jay Powell to go further than a quarter point cut. Are you expecting that we will see a cut in December? And what has he responded to you in terms of your moves to make it a half a point cut instead of quarter?
Yeah, so look, I think that the economy calls for interest rate cuts. I think the economy calls for large interest rate cuts to get monetary policy to neutral as quickly as we can. Monetary policy is exerting, restriction on the economy. It's holding the economy back. It's pushing the unemployment rate gradually upward, and I don't think that's appropriate given the economic outlook. So I think it's the right thing to cut interest rates rather quickly. Now, I think what you'll see on the rest of the committee is that the labor market data that we got recently, I hope will move people in my direction of thinking it's appropriate to continue cutting interest rates. I think that's what the data call for. And, my guess would be that's what we get, but I can only at the end of the day speak for myself.
Look, I know that you're following your mandate and your colleagues are on a mandate, but when you consider some of sort of the larger issues happening, like, for example, AI is expected to replace jobs in a big way. Yes, we're going to have new jobs coming up, but that whole structure and this issue of joblessness has to be something that you will think about for the future, right? I mean, does this macro story and how it's played out, how it's expecting to play out, work into their thinking as well, your colleagues? Yeah,
people talk about AI a lot. AI is something that I find difficult to quantify. I think it's very hard to sort of put precise numbers on the footprint of AI in the economic data on a real-time basis, other than, say, in some of the investment data that you get about capital formation in the economy. But when it comes to thinking about what AI means for the future, if you get AI replacing some workers at various parts of the labor force, what that does is it's both disinflationary because it's disinflationary because you have a new technology allowing you to produce more with less. It's classic pushing out the supply side of the economy, and it also makes us fall further behind on our employment mandate. The Congress tasked us with stable prices and maximum employment, and on both of those counts, AI would encourage us, in my mind, to move interest rates a little bit lower down.
So, what do you want to say about the mandate as it relates to employment? Because we're getting all this data now after the government shutdown. We'll get retail sales this morning. We'll get the producer price index. What about jobs?
Yeah, so that is the key question. Now, as I look forward into 2026, I see a few reasons for optimism. Right, I see the effects of deregulation continuing to kick in. I see the effects of tax policy, like full expensing of investment, continuing to kick in. I see the effects of the trade deals in which other countries have committed to invest in the United States kicking in, and the dissolution of uncertainty over trade and tax policy. However, we have to recognize that the unemployment rate has been drifting higher, and that is a function of monetary policy being too tight. Now, my concern is that if we don't continue cutting rates and do so at a reasonably quick pace, that monetary policy will nip all those positive developments in the bud, and we will not get the recovery in the labor market that I think that is appropriate.
Well, you make a really good point in terms of the expensing, because that is going to dictate decisions on the part of corporate managers. If they're able to expense things, well, then maybe they will hire more. Maybe they will invest more in their businesses. And we'll see that as a result of the big, beautiful bill in 26.
Well, we may if monetary policy doesn't get in the way. Now, I think it's really important to understand that if you push out the supply side of the economy, that is, all else equal, disinflationary. And when you think about sort of things like loosening regulations or capital deepening in the economy that allows you to produce more with less, those are things that push out the supply side of the economy. And in my mind, pushing out the supply side of the economy means that you can accommodate lower interest rates.
Well, tell me about the path in 2026. I mean, are you still waiting on sort of expectations for the year? But because we're going to have a new chairman of the Fed, and we expect that you will have sort of a leaning toward lowered rates. But are you talking about a potential string of rate cuts in 26? Or are you talking about a large 50 basis point cut now and perhaps take to the sidelines next year?
Well, so my view is it's appropriate to get to neutral rather quickly, and I've been very clear about that, and I thought that was appropriate in a series of 50 basis point cuts. As we've been making progress, it becomes a little bit less urgent to get to move in such outsized moves, because we have been making some progress bringing interest rates down. The big difference between myself and I think where the bulk of the committee is not necessarily on what the end destination is. I think a lot of people, if you look at where their projections for the economy go in what we call the dots, they have us getting towards neutral rates. It's just over the question of how quickly we get there. And I want to get there rather quickly because I don't see an inflation problem. I do see potential risks to the labor market. And many of my colleagues sort of see the other way around, where they do see inflation problems. In my mind, almost all of the inflation excess is a mirage. It's due to supply-demand imbalances in the housing market that were a thing in 2022 to 2024, perhaps, but not a thing now in 2025 and beyond. And because the monetary policy lags, we need to set policy for 2027. There's just a really, really long time in which it takes for market rents that you see on Zillow, or if you renew your lease now, to work their way into the inflation data. And market rents have been running at about 1% for a couple of years now.
So does it not concern you that, I mean, we just had Newt Gingrich on, and he was talking about, look, higher health care insurance, higher auto insurance, higher cost of housing. I mean, this is all, part of the conversation underway right now with Republicans about affordability. Do these things not concern you in terms of a potential bigger spike in inflation?
Yeah, so they absolutely do concern me. However, I think that one of the key points to make is that monetary policy works with lags. It doesn't hit the economy immediately. It takes 12 to 18 months to work its way through the economy, which means that right now we have to make monetary policy for 2027. Not for 2025. And a lot of the things that you just mentioned are reflective of past supply-demand imbalances, not future supply-demand imbalances. And it takes a long time for those low 1% market rents to work their way into the official measured data. And that's true for some of the other things, too. For example, you look at food services and dining services. Those reflect past wage increases, and we're just sort of seeing catch-up to what happened in the past. We have to be forward-looking and make policy on a forward-looking basis. We should not ask Americans to lose their jobs because of artifacts of the statistical measurement process, because of quirks of the statistical measurement process that reflect supply-demand imbalances from 3 years ago.
Really, really fascinating. Look, Governor, I want to get your take on something that you said about a week ago. You were applauding the Fed's efforts to replace maturing agencies' mortgage-backed securities on its balance sheet with Treasury securities. And you were also calling for the central bank to avoid large-scale asset purchases. Tell me about this in terms of quantitative tightening going to quantitative easing. What is the path?
Yeah, so as you know, in a few days, on December 1st, the Federal Reserve is going to stop the roll down, the runoff of its balance sheet. Right now, when a mortgage that the Fed owns matures, that mortgage just disappears from the balance sheet, and if the person refis or takes a new mortgage or moves homes or whatever, then that new mortgage has to be absorbed by the market. In a few days, what will happen is when that mortgage rolls off our balance sheet, we'll replace it with a Treasury bill. And so there's still the injection of that credit risk and interest rate risk into the market when the person refis or moves homes, but we will keep the size of our balance sheet constant because we'll be buying Treasury bills instead. Now, in the past, the reason why we have such a large balance sheet is in part because we did all of these large-scale asset purchases, what people call QE. And that's very distortive of markets, and it locks the Fed into monetary policy decisions that last several years because it's difficult to sell the securities, because it takes a really long time to roll down. At some point in the future, we'll move from a position of, right now in a few days, we're going from QT to flat balance sheet. And at some point in the future, we'll go from a flat balance sheet to an expanding balance sheet because we need to purchase securities in order to maintain a minimum level of reserves in the system that banks need for the regulatory system.
Well, I mean, there's so many implications to this, and that's why I wanted you to explain it, because I think there's a sense that it increases the probability that the FHFA will push Fannie Mae and Freddie Mac to actually significantly boost their agency MBSs. Is that one outcome here?
Well, I think that it's important that the Fed not have a big footprint in markets any bigger than it needs to. And that means, in my mind, smaller balance sheet and less credit risk and less interest rate risk in the balance sheet. That means more bills and fewer things like mortgages and longer dated Treasury securities like notes and bonds. And so my preference would be to sort of continue focusing on increasing the size of the balance sheet that we have in bills at the expense of other things. And what happens with agency MBS, it will really be up to FHFA and Treasury and all the other agencies that are involved in that.
Well, I mean, we've gone up, down on the balance sheet over the last 20 years, I guess. What is a practical size of the Fed's balance sheet in your view?
Yeah, so I made a speech last week in which I described the state of the balance sheet as one of regulatory dominance, right? People throw around the word fiscal dominance left and right, but the truth is that the size of the balance sheet, which is a core monetary policy function, is determined by the regulations we have. The regulations tell banks you have to hold reserves for high-quality liquid assets with a preference for reserves for liquidity management purposes, to manage should you have outflows from your banks, deposit redemptions, deposit flight. You need to hold reserves against those. So we tell the banks that they have to hold reserves. That creates a minimum level of reserves that the banking system needs, because if the banking system doesn't have those reserves, then you get banks bidding up the price of various short-term interest rate stuffs to get the reserves they need for regulatory purposes. And that creates the mayhem in the short interest rate markets that causes us to have to stop roll-off of our balance sheet. We can't control the size of our balance sheet for monetary policy purposes. It's ultimately set. The minimum size is ultimately set by the regulatory framework. So my hope is that we continue with the bank deregulation that we've been doing, continue right-sizing the regulatory apparatus, maybe rethinking the regulatory apparatus, and that will allow us in the future to resume runoff, even if we have to sort of begin reserve management operation purchases in the near future.
This is a really important point that you make, and it also leads me to the issues around housing. And when we're talking about housing, whether it's on affordability or supply, do you think any of these moves actually materially boost housing supply? Because isn't that the underlying issue for that market?
So some of them do. So if mortgage rates are lower and interest rates are lower, then it's easier for builders to invest in building new supply. There is a link from what we do to supply. But at the end of the day, there's so much more that goes into supply, and I think that that's actually a rather small element of it. The things that are holding back supply are, at the end of the day, a variety and patchwork of regulations at the federal, state, and local levels. And the Federal Reserve has limited ability to control those.
Yeah, I mean, there is an impact indirectly when you have allowing more buyers to pay up for housing. You got a competitive landscape. I mean, that pushed prices up in the last couple of years.
Yeah, I mean, I think that's one of the elements, and something else that I've been drawing attention to has been the effect of immigration on home prices. There's an abundant economics literature about the effects of immigration on home prices and on rents, and the truth is that the supply of housing is relatively fixed in the short run. You can't pick houses off of trees; they take a while and a lot of money to build. And if you have an influx of millions of new people into an economy, it doesn't matter where they come from; they're going to push up rents and home prices. And I think that was a driver of some of the inflation that we saw.
This is such a great point, and I want to really delve into it a little more in terms of immigration and the impact on housing. Also want to get your take on the oversight of the banks, because a lot of the banks felt that in the last 4 years, even beyond that, when you're talking about all of these rules about holding capital, it held them back. So let's take a short break and come back with Federal Reserve Board Governor Stephen Miran on the other side of this break. Stay with us. Welcome back, and I am back with Federal Reserve Board Governor Stephen Miran. And Stephen, I want to get your take on the backdrop here. You've been now in the job as Federal Reserve Governor for 2.5 months. Of course, you were the chairman of the Council of Economic Advisors, and now you're on leave there. How's it going? I mean, you walk into, I don't know, what could be a lion's den here. President Trump appointed you, and he's always trying to pressure Jay Powell to cut interest rates. How are the meetings going?
So everyone's been very collegial and very friendly, and I've been really appreciative of that. And so in that sense, it's been a really great experience. And we all keep our arguments to economics. Like I argue my economic views and others argue theirs. And at the end of the day, the data will show who's right. And I think that, it'll take time, but I believe I'm right. And so I think that people will come around to my views.
Well, one of those arguments was the argument about tariffs. And President Trump has been very effective with these tariffs. Of course, we'll see what the Supreme Court says and whether or not the president is right. He says these payments will be record-setting and put our nation on a new and unprecedented course. Those opposing our tariffs are serving hostile foreign interests that are not allowed with the success, safety, and prosperity of the United States, the president tweeted out. I spoke with Commerce Secretary Howard Lutnick yesterday about the SCOTUS decision, and here's what he said.
We are going to win the case. It's pretty clear. I sat in the Supreme Court. We're going to win the case. But the fact is the president has all sorts of policies and tools throughout. He's got tariff rules of 232 in my department. He's got 301. He's got 338. He's got tariffs are going to be a part of this administration's national security and national economic protection of the American people. But we are going to win the case because this president has proven that he can protect America, and IEEPA is protecting America.
And IEEPA, of course, the international emergency rule that allowed President Trump to issue these tariffs. Now, I know we don't know where the Supreme Court is going to go, but what is your sense of the importance of these tariffs? Because all of a sudden, in April, everybody was just crazy over the tariffs, and we had those massive sell-offs. And now, as we await this decision, people are like, wait, if the tariffs go away, we're going to have to pay back $200 billion. We need those tariffs in place. How do you see it?
Yeah, so look, this is another issue where I think folks have been moving in my direction all year, in the sense that I claimed from the very beginning that I didn't think there would be any material spike in inflation, and there hasn't been. And people have been marking down their expectations of inflation from tariffs all year long, and that continues. What the tariffs do from a monetary policy perspective is they increase net national savings. And that increase in net national savings has allayed concerns about the Treasury market, has allayed concerns about the bond market and fiscal sustainability. And it's served to further reduce what we call the neutral rate of policy that allows us to sort of run monetary policy at a slightly lower rate because there's more national savings in the economy relative to the amount of investment. And so it's been important for those revenues to, I think, calm financial markets. And so they've been a big contributor to the stability of the financial system in that sense. But beyond what that means for, and I've spoken about what that means for monetary policy, and I covered this, I think, in detail in my first speech that I gave as a member of the Board of Governors of the Fed. But I can't speak about tariffs beyond that because it's sort of outside of the purview of, I think, things that the Federal Reserve covers.
What are your assessments of the 2026 economy? I mean, we're talking about inflation, we talk about the job situation, you're also talking about the balance sheet runoff. Give us your sense of the macro story in the new year.
Yeah, so as I said before, I think that some of the things that held the economy back in the first half of the year, things like uncertainty over trade and tax policy, as the global trading system was being restructured and as the economy potentially faced the biggest tax hike in its history, held back the economy in the first half of the year, and that's dissolved. And so there's a reason for being more optimistic as we sort of turn the page into next year. And on top of that, there's other items like continuing rollback of regulations, the full expensing from the tax bill, some of the trade deals that have been mentioned. And these all bode well for the economy into next year. From a regulatory perspective, we're peeling back bank regulations at the Fed, which allows banks to better inject credit into the economy. However, I continue to emphasize that monetary policy is still too tight, given all of the changes that have been occurring in the economy. And that tightness of monetary policy has overwhelmed some of these positive factors thus far. And if we don't actually continue recalibrating monetary policy to a more appropriate position, we will be the source at the Fed. We will be the source of continuing increases in employment, which is not a good thing.
Easing back on regulation is also a priority of President Trump. What do you want to say about the oversight of the banks? Because the banks have been under massive pressure the last several years to hold more capital, and that has held them back from investing into the economy.
Yeah. So look, I mean, I think that's a great point. I think that the banks have been asked to hold too much capital over the years since the 2008 crisis. 2008-2009 crisis, and that has prevented them from extending credit into the economy at a pace which I think is healthy. And you see that in the rise of things like private credit, which benefited from regulatory arbitrage because we made it too expensive from a regulatory perspective for banks to lend, and so non-bank financial institutions dramatically increased their lending into the economy as a result of that. I support Vice Chairwoman Bowman in the work that she's doing, peeling back some of those regulations and reducing the amount of capital that the banks have to hold, because that's the way that we can get them to extend credit into the economy in a way that makes for a healthy economy for all Americans.
Real quick before you go, Stephen, do you think that it's a given that once rates come down on the short end, let's say you're right, we get a 50 basis point cut. I don't know if Jay Powell goes along with it, but let's say, do you believe that does ultimately lead to a cut in mortgage rates long term? Because we need some relief on mortgage rates right now.
Yeah, I do agree we need relief in mortgage rates. When you look at financial conditions, some people argue that
but it's not a given. It's not a given.
No, it's not a given. Some people argue financial conditions are very loose because of the stock market, but housing is what really matters for the transmission of financial conditions into the economy. And financial conditions in mortgages and housing markets are still very tight. I do believe those will come down as we cut interest rates.
I mean, it goes back to whether or not the Federal Reserve is going to buy agency mortgage-backed securities for the portfolio in an effort to drive down mortgage rates going into the midterm elections. Probably not.
Well, but it also reflects whether or not we get the inflation call correct. And I think one of the things that we saw last year after the interest rate cuts that the Federal Reserve did last year in 2024 was long rates actually went up, right? And I think that's because at that time inflation was sort of still potentially a big worry. This time, since we've been cutting interest rates, they've actually come down, which tells us that we're not making a policy mistake, which tells us that actually maybe I think there's scope for us to reduce rates further and more quickly. And the fact that long interest rates have come down as we've been cutting rates is very opposite from what happened last year.
Real quick, final question here. When you look at 2026 in the Federal Reserve, and I know you don't know who's going to be the chairman, none of us do, only President Trump knows. We're going to have a new Fed next year. How will next year's Fed be different than this year's Fed in terms of sentiment toward rate cuts?
Well, that depends on how much rate cuts we get done, but before the new Fed chairman comes in. However, I do think it's important that we continue cutting. I can't speak for anyone other than myself, and I certainly can't speak for people who haven't even been nominated yet.
All right. Great to have you. Governor, good to see you. Thanks for joining us.
Thanks for having me.
All right. Fed Governor Stephen Miran here.